Greetings and salutations. Welcome to the Nick Long Show. I am your host, Nick, and this is episode 5. And today we are talking about a topic that is near and dear to my heart and one that may seem simple, but it can really change your perspective and your outlook on your financial future. And today we are talking about financial statements. When I say financial statements, I'm talking about your personal financial statement. Financial statements are kind of split up into two main sides. The first side is what we will call the income and expense side, and the other side of the statement is the asset and liability side. If you don't have one, at the end of this video or while this video is going on, start putting together your personal financial statement. Everyone should have one. They should keep track of it on at least a monthly basis so you know where you are. Financial statements are like x-rays. They show you what's going on underneath the hood. First, let's talk about the income and expense side. And this is pretty simple. Income and expenses, your income is just how much money do you make each month? Where does it come from? Is it a W-2 job? Is it a business you own? Are they investments? Are you receiving dividends? Are you receiving interest on personal notes that you've loaned out? Where is your income coming from? So that's the income side of the income statement. The bottom part of the income statement is your monthly expenses. This includes everything that you spend money on in the month. It includes things like your taxes that are going out, your debt service on if you have credit card bills or if you have a mortgage. All of that stuff goes on the monthly expense side. I mean, things like subscriptions, you name it. If it's money coming out of your pocket, it's an expense on the income statement. The income statement is to help you just know what's going on every month. Like what direction is the money flowing? Where is it going? Many people have no idea where their money goes each and every month. They don't know how much money they spend on food. They don't know how much money they spend on childcare, movie tickets, clothing. All these things add up. So it's important to be discerning on how you spend your money. Don't just throw money out the door, especially when you're younger and you're just getting started. Be very cognizant of what you do with your money on a monthly basis. The second part of the financial statement is the balance sheet, sometimes also referred to as the personal financial statement or PFS. And that is just your assets versus your liabilities. What is considered an asset and what is considered a liability? Well, we're going to answer that today. The true definition of an asset is something that puts money into your pocket. Traditionally, your house, if you own your house, would go on the asset side of the column. Your vehicles would go on the asset side of the column. A retirement plan would go on the asset side of the column. Cash in the bank, savings accounts. If you have notes, in other words, if you've lent money out to people, that is considered an asset. That will go on the asset side of the column. Even 529 plans, if you have those like for your kids and you've started putting money away, all those things are not what I consider and what others consider true assets. They're considered false assets because they are not putting money into your pocket every month. Now let's take your home, for example. This is a personal favorite of mine, as well as vehicles. We'll talk about those in a second. But your personal home, the home that you live in, it goes on the asset side of the column, but it's not truly an asset. It's what I consider a false asset. You have to pay the insurance every month. If something goes wrong with the property, you have to pay that. You have property taxes each and every month, and then you have your mortgage. It's kind of both an asset and not an asset at the same time. Granted, every month that you pay that mortgage, you pay the principal down a little bit. We've talked about that before in some previous episodes, and that's great because you are building equity in your home, and I strongly suggest that you do make it a point to try and own your own home as soon as possible. I still truly believe that owning your own home is one of the best ways that you can build some equity for yourself. And then later you can tap into that equity to purchase more real assets that will put income into your pocket each and every month. And we'll talk about that as well in the future. Another false asset is your vehicle. Now, you may say, Nick, I have paid my vehicle off. I don't have a payment on my vehicle. It's worth $30,000. It is a great vehicle. It's an asset. I don't think it's an asset. If you are not loaning your vehicle out on like Turo or something like that and making money off of renting your vehicle to other people, then I don't consider your vehicle an asset. You have to pay insurance for the vehicle. You have to pay maintenance for the vehicle. Did I say gasoline? You've got to, all those things, that's money coming out of your pocket each and every month so you can drive around. Now, yeah, if you went and sold your vehicle, you could make some money off of it. But it's not a true asset. True assets like, surprise, what am I going to say? Rental properties. Rental properties, if you buy them right, if you fix them right, if you put the right people in there, those are things that should put money into your pocket each and every month. And we've talked about the different ways you can make money off of rental properties. You get depreciation that goes against your earned income. You have principal pay down and should have cash flow coming off those rental properties. That is, I think, one of the best assets that you can own. Other assets can include a business that you own. Hopefully it's a business that you don't have to be in each and every day. Hopefully it can run itself. Take 6 to 12 months away, go travel the world, and that business would run itself. If that's not something you have, then that's not really what we would consider an asset. You have all your assets lined up on one side, you have all your liabilities lined up on the other side, you add them all up, tally, 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 and you have a number at the bottom on both sides. You have your total assets and your total liabilities. And I know that I've talked about false assets today, but include things like your home if you own your home, include your car, all those things on the asset side of the column. Yes, tally them up, add them all up, get that number, and then subtract that number from your total liabilities. Your total liabilities are things like mortgage notes that you still owe on. So if you bought a home and you have $100,000 left on your mortgage, that is a liability, and that needs to go on the liability side of the column. If you own a car, but you have a note that you're still paying on the car and you owe $10,000, that is a liability. If you have credit card balances, those are liabilities. If you have equity lines on anything, those are liabilities. Any debt that you owe, to put it simply, any money that you owe goes on the liability side of the column. And then you add up all your liabilities and you subtract that number from your total assets. And if that number is positive, that's good. If that number is negative, that's not what we want. If you are in that boat where your liabilities are higher than your assets, then we need to rethink what it is that we're doing. We need to pay off our liabilities, get rid of them as soon as possible, and we need to increase our assets. Liabilities can be good liabilities. So let's say you buy a rental property. The property's worth $150,000, but I have a note that's a liability that I owe $100,000 on. That's okay, because if you bought the property right, the property is paying for itself. You have $50,000 in equity, and you're paying down that liability each and every month from the rental payments. There's good debt and bad debt. Bad debt is just buying trinkets and things that aren't really going to make a difference in your life. Like, I went out and bought a necklace at Tiffany's. That's a bad debt because you just went out and you put it on a credit card. You really didn't have the money to buy that necklace. That is not considered good debt to have. Good debt is money that you spend to buy an asset that pays off the liability by itself. So those are the things that you want to try and focus on building for your personal financial statement. So if you don't have a personal financial statement, make sure that you get started, get it on paper, update it every month. Find a time, do it, know where you are financially, and then concentrate and think about how I can grow my assets and decrease my liabilities. And if you do those things, that's going to set you on the right path. I hope you have enjoyed episode 5. Got a few things back here. Make your own luck.